Awesome. All right, we got one of our co-hosts for the evening, Luke. What's going on, man?
Not too much. How you doing? Happy Wednesday.
Uh,
Happy Wednesday.
Happy Wednesday, man. It's been a while
I
since the
know.
conference.
We're due. We're at Jonah Lupton's conference down in Florida. Now it's all cold up here in Michigan, where I and Benzinga are located, so I could go through some of that Florida weather again.
Yeah, well, come join me. I'll be down back in Miami for April for a couple of conferences.
You
got to roll through.
are you coming to our Cannabis investment conference in April in Miami?
Where?
Oh,
What's that?
snap.
Yeah, exactly.
I heard about this. No. I heard about this. Jonah was talking about this yesterday.
April 20th, Fontainebleau. We are taking the hotel over.
Okay, let's connect offline about that.
Okay.
Or off spaces, because I'm actually very interested and maybe do some stuff with you guys for that.
All right. Open invite for anybody who's listening. It's going to be basically we're going to have 60 publicly traded cannabis companies all giving their investment pitches. And so whether you're
Is there like tickets or anything?
Yeah, but I can always hook whoever up.
Okay, my man. I will be in Miami at that time.
And not just you. I'm throwing it out for the group. If anybody cares about cannabis stocks, and I know that the sector's been in a tough spot, right? But there are really interesting companies. There are SaaS companies. There are reg tech companies. There's going to be tons of folks there. So shoot me a DM if anybody's interested, and I'll hook it up.
Does it come with samples, or what are we talking?
Not event sponsored, but I've been to these events in the past, and the air does smell a little funny.
Okay. All right. I'll keep it in mind. Just for my audience, I had to know.
Yeah, exactly.
What's going on, Joseph or Joe? Good to see you again on these spaces.
Thanks for having me. How are you doing?
I'm doing great. Glad we were able to find a time that worked.
Yeah, no, thanks for the invite and exciting times. If there's gummies, I'll be at that conference. Just let me know.
If that's what we got to do to get you there, we'll bring out the gummies.
All right. What are the 3 stages of gummies? I'm fine. Take me to the emergency room. Maybe I'll be down there. You never know.
Yep. Sounds like we're recasting Ted. It'll be a good time. What's up, Andrew? Long time? Not really.
What's going on, man? The Iron Man of Spaces. How are you doing?
I'm good, dude. I'm good. Honestly, today was kind of light. I have clocked 4, 5. Let's see. I've clocked 5 hours on Twitter today. So to be honest, pretty light. So I'm feeling good, rejuvenated. I actually just went to a friend's engagement party for the last hour, and I had to basically dip. I was like, yeah, sorry, business calls. But life is going pretty good. I just had some sushi, and we're rocking and rolling. Monday, Tuesday were crazy. I clocked 20 hours on Spaces in 2 days. I don't know. I was feeling a little tired, but today's good.
That's a good nickname for you, the Iron Man of Spaces. I like that.
I like it. I'll keep taking them, whatever anyone wants to throw out. And Blake, you doing good?
Yo, what's going on, everybody? Yeah, it's good to see everybody. What's going on, Gav, Andrew, Joseph? What's going on, people?
Doing great. Okay, let's get rolling with this. We may have a couple other speakers join up, potentially stock talk and stock market news. We're going to have to see, but we have a great panel up here now. I'm excited to get going. Luke, I dropped you a co-host invite if you do want to accept that. And also if the Benzinga account, I know that you may still be having problems being a speaker, but I think they did fix it for Android. At least pretty much they fixed it. And if you update to the newest version of Twitter on Android, that should definitely help out, and then we can get you up here. But let's get rolling with it. So I've been chatting with Luke. If anyone's unfamiliar, Hot Stocks Luke up here. Luke Jacoby, one of the main hosts for Benzinga, running the Zinger Nation feed. You can catch them on YouTube and a number of other platforms. And you've probably seen Benzinga inside of your own personal brokerage. They pump out news like wildcats. It's awesome stuff. So anyways, I had the pleasure of meeting Luke back at a conference, Jonah Lupton's conference, and I've ever since really wanted to do a couple more spaces with you. I think we did one in the past. And when I think, Benzinga, I think hot, trending, fast, what's going on? So I wanted to do analyzing trending stocks, but I also wanted to throw out, some stock picks too. But Luke, I'll turn it over to you first for if you have any thoughts on the market right now, if you want to share them. And then if you have any tickers you want to pull out and throw those out there, and then we'll kind of make our way around the circle.
Cool. Let's start off with general market thoughts, and I'm curious what everybody else thinks. but for the first time in a lot of years, I think like we're actually starting to see like some valuation type picks come into play. I know that it's a little bit scary to go after some of these hot names right now. I'm scared to go after some of these hot names right now. But when you have a stock like Facebook that's now trading, down to below 5 times price to sales, Netflix, you have the same way. They've gotten halved, clobbered, right? Peloton kicked the crew off, but before this tech sell off. But when we start to see, some of these valuations go from 10 times sales to 5 times sales, and it's like, okay, you have some of these nice growth stocks that are trading in line and, with the averages of the S&P 500, I think that it starts to make some of the stock picking a little bit fun. Curious what everybody else thinks about that.
Yeah, I mean, I think we're kind of at a point where growth at a reasonable price is actually possible in some cases. And, this is an environment where we are in the cycle where companies that are closer to producing free cash flow and or bottom line earnings are going to be in a really good position. And we've seen some great discounts on quality businesses. Pretty much everything's gotten thrown out together because there's so much deleveraging. So I agree. I think there's going to be opportunities to be selective. I mean, what we saw last week with Unity and Bill, crushing it on earnings and really getting a solid bid since, I think is also giving, some precedent to the idea that, yeah, there's actually some opportunities in this space for the really high quality names.
Yeah, that's exactly it. It's the growth at a reasonable price is actually possible right now.
Okay.
Yeah, I would add, Alan, to that. In the tightening cycle that we look like we're heading into, and it definitely has its challenges for higher valuation, especially those high price to sales software stocks. So I definitely agree with Luke that, when it's sort of the faucets are open and there's a lot of liquidity, they kind of forgive a lot of things, but especially with the 10-year rising, like when the 10-year went from roughly 0.9 to 1.9 in February of last year, a lot of the tech stocks and high valuation names got hit, and you're seeing that happen again. So it definitely makes it for more selective in a stock picker's market.
Very interesting take. And I do like the style here. I'm happy if anybody wants to just pop in. Maybe we use the hands if we want to have this more of an open forum. I obviously typically pretty heavily moderate, but happy to have some back and forth. Andrew and Blake, if you have kind of thoughts on that topic, and we can go from there. You guys want to weigh in?
Yeah, sure. So, yeah, I think that's a great point that we're getting new groups of stocks that are leading. So we have these names that, they're not the sexiest names that are actually in really nice trends. But what's interesting is over the past month or so, we've seen all these headlines, like even before the indices broke, like 80% of stocks in the NASDAQ are down 50% or more from their highs. And I'm noticing with a lot of the growth stocks, a lot of them, they were down like 50, 60, 70, 80%. And it looks like things got a little bit overcooked to the downside because we're starting to see, when these companies report good earnings, they'll just have like a quick 20% move to the upside. So it's very interesting because there's the case of do I go for some of these beaten down growth stocks because they're having some fast 20 to 30% moves, or do you go for the higher quality stocks that, to be honest, they're a little bit more extended in many cases, but they're really the names that will probably thrive in the lower liquidity environment.
Yeah, and just to kind of tag onto that, Andrew, to answer your question, I think you already answered it yourself. Me and my personal trading philosophy, I'm not the person that's chasing these stocks that have been, beaten down over the past, 6 months. I'm not somebody who's going to be picking a bottom. I'm more into the quality, and right now, it looks like the financials are looking really hot, really strong. We had Morgan Stanley today, and I think the banks are going to continue to outperform some of these other sectors, especially with the current environment that we're in.
I'll pick it up for a second on the financials because I like that too, right? We obviously there's the obvious narrative of rates go up, banks are going to make more money off of interest payments. That's of course is interesting. Here's something else that I don't hear talked about a lot that I think can be really interesting. We have a guy who's really good at analyzing the bank stocks. His name is Tim Melvin. If you care about small bank stocks, look him up. And basically the thesis is now that these larger, let's call it the mega banks, the Morgan Stanleys, like we just mentioned, the JP Morgans, and some of these regional banks are going to be more cash flowing. It actually creates a buying opportunity for us as investors to go after some of these community banks. There's, let's call it 500 publicly traded really small banks. These are 2 to 500 million market cap banks. They might have 10 branches, but they typically have really, really good balance sheets. And I think that as banks become more cash flowing, there could be some M&A activity in some of those smaller community banks. So you sort of have the double thesis. You have the increase in interest rates. They make more money. And then two, you have now some of these ones, especially the ones that have been increasing deposits, have the strong balance sheets, can become takeover targets.
That is very interesting. With the banks, they've had such a great run. I've been trading the banks, here and there. The question that I start to ask myself at these levels, though, and granted, like Morgan Stanley, it's on really just like day one or day two of its breakout. For me as a trader with my style, it's like I always want to go for what's in the uptrend, whatever. But like as these things start to enter, like, okay, this is in another base. Now it's basing again. It's in another base. Like for me, I always ask myself the question of like, is this bank going to give me like, a 20, 30, 40, 50% return? Or am I like picking up pennies in front of a steamroller? Because a lot of times in a market where like all these like consumer staples and financials are leading, a lot of times that's just like a market that you don't even really want to be involved in. So I'm trying to play those themes. But as these trades start to get like a little bit more noticed, a little bit more crowded, I'm kind of cognizant that like, hey, there could be some risk here, and there might not be like a really asymmetric payout to getting along the banks.
Yeah,
I pulled back the throttle on energy, but banks I still think got a lot of room. Sorry, Joe.
Oh no, I was just going to agree with this point. I think it just depends on your style. Like growth has been working well for the past several years up until recently, and there are a lot of stocks, if you want to call them the Kathy Wood stocks, that went up 100 to 500%. And if you want to talk about the elephant in the room, a lot of people love trading those stocks that appreciate rapidly in price. They give people action, whatever you want to call it. But you have to accept that there's also, every dog has their day, and sometimes value will do better than growth. So you have to define. I think what helps give people clarity is to define your style. Like I'm a growth manager, so I'm not going to traffic in banks and a lot of utilities and a lot of the defensive names because that's not what I do. But what I do is wait patiently for the growth stocks to set up because I have a certain style that, as humbly as I can say this, I'm trying to be confident waiting. I'm confident that when that lines up, I'll take advantage of it. I think one thing it's important for traders to do is to define their style, and rather than trying to chase the sector rotation, because that's a losing game.
Yeah, I just wanted to add in also, Bank of America did a fund manager survey, and late cycle plays are the most crowded trade that they've ever been. I mean, the allocation that fund managers have to energy, financials, and materials is the highest it's ever been. The allocation they have to tech is the lowest since 2008. That doesn't mean it's a contrarian buying signal in tech, but it does show you it's a little bit washed out. And in terms of the banks, the way they make money is really lending the spread, right? So they're really borrowing from the short end, leveraging up and lending on the long end. Well, what's been happening with that spread is it's actually been flattening out. So this isn't really the greatest environment for financials. We might see that catch up longer. Short term, the trends look very healthy. I mean, I'm a trend trader too. I love what KRE is doing, and I'm happy to ride that trend until it stops working. But from the macro side and from the sentiment side, things don't look perfect for financials here. So I would be a little bit hesitant longer term there.
Yeah, that's a good point. And it also depends on, real quick, on how high you really think rates are going to go. That's another factor too.
Loving the macro back and forth. Happy to continue with more of that as we go into it. Also would love to bring in some maybe specific stocks, talking about what's hot. Stock talk. Speaking of stocks, appreciate you joining us.
What's going on? What's going on?
Doing good. We've kind of been chatting some macro. about first off. I think like people have been talking about their styles. We're going back and forth on that, but I would love to also pull in some specific stocks here if we want to walk through them and to each person if they kind of want to pull out what's been trending for them and have a few minutes to just talk about different areas of the market, what they've been playing. Maybe we'll have some recurring themes through here, and we can go from there. And then if we want to come back to more of this macro and style talk, I'm totally open to that as well. I've definitely been enjoying the bounce around. But Luke, I want to bring you back into this. So you've been running a lot of shows and doing some stuff for Benzinga. I know Bry's been doing stuff too. What's been hot lately? What stocks are people talking about? What's been popping off? And what can we go down the rabbit hole with?
Yeah. So I mean, is it okay if we bring it back to some of these big tech stocks that have just gotten totally obliterated?
Of course.
All right. So let's go back to those. Three names that I'll give three names that have been popping up and are on my radar. And they're all a similar story. Let's start with PayPal, PYPL. Stock got clobbered. Let me look at a chart right here. So we had highs a couple months ago in the summer, 310. Stock's at 122 right now, so it's down 60%, 65%, something along those lines. Stock is still continuing lower, right? It's not made an upswing in a similar way that Facebook's given us a little bit of an upswing, that Netflix has given us a little bit of an upswing. Stock is still continuing lower. But what we're hearing from a lot of folks and in similar opinion that I have is you now have a stock like PayPal that's trading at below 5 times price to sales. It's got nice margins. It's nicely cash flowing. It just gave up over 2 years of stock price appreciation. Are these names interesting yet? When is the bleeding going to stop? If I'm picking a bottom, is the floor about to fall out from that bottom? But that's been a lot of the commentary is around a lot of these big tech type names. I personally am in Netflix right now. I got lucky as hell with a 455 average on that one. Looking at that as a swing trade, I think it might be time to start looking at Facebook as a swing trade to the upside as well. And then PayPal, whenever the bleeding stops and we get a couple of green candles, could be the same thing.
I like where your head's at in terms of looking for opportunities out there. I think one thing that's important to talk about with that is also kind of how we quantify a reversal, right? Like, are we looking for a kind of a higher high and a higher low? Do we have some kind of technical indicator that we're looking at? Like, what do you tend to look at to kind of quantify a reversal, saying, hey, it's safe to enter here and I've quantified my risk? Because I'm always trying to ask other people. I've got my own ways of doing it. I'm happy to share that too, but I'm curious to hear from you first.
Yeah, I mean, you got it. We want higher highs, lower lows. My general gut check that I've used for years is that I want at least 3 green daily candles. If I get those three green daily candles, and on that fourth day, if stock is trading towards high of its day, that's been my general gut check that hey, we have some momentum in this name. I always like to look at a couple things, right? I want to. I'm a little bit unique in this, in that I want the story and I want the fundamentals to make sense in the longer term. I think that protects your downside a little bit. But then I also want some of these shorter term swing trade type characteristics to come through.
No, that makes a lot of sense. Having multiple vantage points to validate your thesis, right? Not just relying on technical, but having some fundamental and or macro in the picture can certainly help. One thing I wanted to say, I first will talk about kind of how I quantify the reversal. I look at the same thing. I look for a higher low and a higher high. I look for, usually a break above the 8-day EMA. I think that's a pretty good average that a lot of folks are looking at. I don't wed myself to any particular average, but I think for, shorter term timeframes, that can be helpful. I also like to look at Ichimoku Cloud, and you can say from that, whatever the time frame you're looking at, once you get above the cloud, you're in an uptrend per that method of technical analysis. And I like to look at prior levels of support that have become resistance and whether or not we're really starting to break above those with some conviction, with some rising volume. Then I feel a little bit more confident. And like you said, I like to see some coalescence on the fundamental side and the macro side. Is there some safety in the balance sheet? Is this a company that, if I was a big private equity firm, would I feel comfortable taking it private at this valuation, right? Would I feel like that would be an accretive investment? That's another thing I like to look at. And I like to look at the macro backdrop. And I think really for a lot of the stuff, that's the greatest area of uncertainty. How does the economy do this year? Does inflation materially slow in its velocity? Prices are obviously going to be somewhat sticky. And then what does the Fed do with all that? Are they able to really walk that tightrope of governing inflation, most of which they don't really have a role in creating or being able to control, and also balancing this ever increasingly leveraged global economy with so much debt in it that's interest rate sensitive? So it's going to be a very interesting year in terms of the macro signals, I think, too.
Yeah, definitely going to be interesting. In terms of how I'm defining the trend reversals, I've been working off of two watch lists. I have one watch list where it's all the liquid names that are in true uptrends. So as of right now, I believe there's like 190 names on that list. And these are stocks where the stock's above the 200-day, it's above the 50-day, 20. All those key moving averages are stacked. And these stocks, they pretty much are just like financials, energy, a few select groups. But then I have another list, and that's my trend reversal list. And these names are primarily all of these growth stocks that are super beaten up. So with those, what I'm looking for is as these companies go into earnings, a lot of these names like Snapchat, for instance, when Facebook reported earnings, Snapchat went down by like 25% on the same day. And the thing was just completely washed out. So, of course, that thing is just in a bad downtrend. But what I'm looking for is when the company reports, what does that reaction look like? So, for Snapchat, for instance, the stock went up 60% in one day. And I bought Snapchat in the after hours market. And that's one of my core positions that I'm holding right now. So, for that one, all it takes is the one candle. Hey, if it reports earnings and everything flips and the stock closes strong and it's nice and green, that to me is a trend reversal. And for a lot of these other names that are in the growth space, like today, for instance, a lot of them are reclaiming that 20-day moving average. So I'm doing a distinction between, hey, here are the growth stocks that are above the 20-day moving average, and then here's the list of the other ones that haven't yet made it over.
And that snap move was so wild. That was crazy. I don't remember the last time. Does anybody remember any post-earnings move like that?
Yeah, Snapchat going down on me when I bought calls the time before.
Yeah, they've had some bad prints.
Well, you got to remember, to his point, it dropped 25% on Facebook's earnings. So, yeah, it was a monster move, but it was already down 25% the day before, the day of the earnings, in sympathy with Facebook. So, my only challenge, and I respect there's a lot of different ways of doing things, my only challenge with taking a position in something like that here is overhead resistance. I like using the gap up on earnings for gap up plays and using that big candle, as you mentioned, as a potential, but I like them more when they're closer to highs because, to me, at least for my style, there's just too much overhead resistance for people who bought it at 80, at 70, at 60 that are just like, get me the heck out. So I have no problem with doing that, at least from my experience, is that you just have to accept it might take a long time for it to plow through that overhead resistance.
Yeah, I definitely agree. That's why for a name like Snapchat, I'm making sure that, like, if I'm not in the money and making a profit very quickly on a name like that, like, I can't stay in it. Like, I fortunately bought it in the after hours because I saw the expectation breaker that was happening. But for me, what I'm making sure to do is for these growth stocks, I'm selling them into strength. So I've already
Yeah.
sold off 60% of my position in Snapchat. Now I have 40%, and I'm like, oh, okay, this, I can hold and, see what it does. But yeah, I completely agree with you. These names have so much overhead resistance that, yeah, I'm not really expecting any of these to, just run back to the highs quickly.
Yeah, no, I think that's a great point. Like, there's a lot of different ways, and it's very strategic. And I like the way you defined risk and took some profits and you monitor after hours. But like an example, like like if you, it also depends on your time frame. Like if you just said I'm going to bottom fish Netflix after the earnings, and you got lucky that Ackman took a position in it and it popped 20%. It depends on your time frame. Some people might say, okay, I'll take those gains. But if you're holding it longer term, you have to accept that it's going to take some time. Like, for example, if you look at Boeing after COVID hit, I know a lot of people said, well, Boeing's down from 400 down to 120. I want to buy it. And there's nothing wrong with that. They're not going out of business, nor is Netflix or Snap or any of the ones that got hit. The problem is when you look at that chart, I'm just trying to stress the point, depending on time frame, if you're looking to hold it longer term, it's going to take a long time for these things to base out and recover.
I think that's a really good point. I think I would add to that too that we've seen some very unprecedented trends in terms of retail participation being about 35% of total transactional volume on the market. And last year was a kind of a banner year where there were more options bought than shares bought by about 50%. And we had two such instances where the premium paid for calls and then later the premium paid for calls and sold for puts on equities was at record breaking levels, both at that sort of February top that we had in the much more speculative growth and then that November top that we had in some of the sort of less speculative growth, but still similarly frothy areas of the market. And I think that options-driven participation changes time horizons. Often is the case that people are punting things that are expiring the same day, within a week, within a month, not often going much further out than that. And that amount of leverage also kind of changes the distribution of fat tail risk. We're in a much more leptokurtic environment, and that means that things can really swing wildly. I think that's one reason that Snapchat moved the way it did. I think that's another reason that we're starting to see that level of volatility percolate into higher levels of the market, all the way to the index level, where in January we had 4, 5, 6% swings intraday and things like the S&P and the NASDAQ, because there's less liquidity and there's more options driven participation and there's more extremes in sentiment, and all that whips up a kind of wicked brew. So that's not necessarily 100% behind us, although we're seeing volatility fade a bit here. I think the amount of options driven participation, which again, I'm bringing it up because we saw it today. A lot of the sort of FinTwit favorites were bid up on huge amounts of premium paid for calls, and these are short dated, near the money calls. So that sort of delta squeeze action where prices are being pushed up because volume exceeds open interest, and market makers are starting to auto hedge this stuff by buying shares to make sure that they don't have to, essentially lose money on those contracts. So I think that's another thing that we should be paying attention to as to why things are moving. Typically, when they're driven by options action and that premium starts to fade, people aren't buying it anymore. You can see it go in reverse because the natural flow is to remove those hedges by selling those shares. And we saw it last year with Upstart, Affirm, Asana, and some of these other high flyers. Day after day, there were just people walking up the strikes in these near dated calls and pushing prices higher, even multiples higher. And what was leaving behind was very poor price structure and a lot of just pockets of hot air. And a lot of that ended up being retraced. And I'm not saying that's going to necessarily happen in the here and now, but kind of know what you own, why you own it, and what's moving price. I think that can be really important to managing risk.
Yeah, that's a really quick. That's a really good point. I think people underestimate how much the options market and all the derivatives market really plays a role in market movement. So yeah, thank you for adding that.
Hey, real quick, stock talk.
Oh
yeah, what's up, Luke? And then I'll go to stock talk. What's up?
Yeah, I was just going to make the point too that I love the like know what you own and why you own it. I find personally there's times where I become undisciplined and I have all this stuff sitting in here and I just need to take like a weekly check to go through here because I swing trade. I do stock picking and swing trading. I'm not intraday. But I really just need to go line by line. What was the thesis on this one? Is the thesis still true? Should I still own this? Is the thesis busted? I'm such a strong advocate of know what you own and why you own it. If the thesis has to keep changing for you to keep owning that stock, you probably don't want to be owning that stock anymore.
Yeah, definitely. I love to see when people can, one, admit that their thesis changed, right? And admit that something has changed that doesn't fit their thesis anymore, because stocks change and companies change, and sometimes you have to move out of it. I mean, we should have gotten Brad Friedman on this space. That's right up his alley. One thing I would love to ask, if anybody's in the audience and hasn't already, shut up and Benzinga and others who I've seen done this, if anybody could share out this room, that would be fantastic. We're only 30 minutes in. We'll be running for a good amount longer, going through some stock processes as well as individual stocks. Loving the conversation that we're already having so far. Great having a couple of speakers who haven't been on our spaces too regularly. So we've got Luke and Mayhem, Markets and Mayhem, and Joe joining us. And then Blake and Andrew, of course, were on our space last night in Stock Talk. And Stock Market News are always on my spaces. And shout out Benzinga for coming on and coasting with me. Excited to see everything you guys are doing. So if everybody hasn't already, go ahead and check them out, everything they're doing in the Bullish Rippers account, and give them that follow. We're about halfway through the week, which means we are up to, I think, about 10 or 11 spaces already from the Wolf account. So if you're enjoying spaces, I recommend taking a look at my pinned tweet real quick, and you'll see we have 22 spaces scheduled this week. And if there are any topics in there that appeal to you, I'd recommend marking them off on your calendar or joining our free public Google Calendar by just shooting me a DM. We now have 3,200 people on our free public Google Calendar. They can see when all of our spaces are occurring. It is completely free. We show speakers, times, topics, and we even put recordings in there. So once more, all you have to do is DM me and just shoot over a Gmail. If you don't have a Gmail, another email works. And then, of course, make sure that you're following myself and the co-host so that you see our spaces when they come up, when we are running them. I did 20 hours between Monday and Tuesday, so pretty often they are. All right, Stock Talk, wanted to bring you into this on the topic of how to recognize a reversal. So we heard Luke, he has his 3 days rule. We heard from a couple other speakers. When these stocks are in free fall, what do you look for before you will go in and take that position? I know with day trading it's a little bit different, but perhaps for a swing or even something longer, what are you looking for?
I mean, it depends on what stock you're looking at and what sector you're looking at. I mean, from a technical perspective, I mean, you're looking for the chart to retake key moving averages that it's forfeited, right? So if you're looking at stocks that are pinned under the 50 or the 200 and they retake those moving averages with volume, and you can count that as a more substantial move, you have to look at relative volume of the move. You know, that's how a lot of people get faked out by bounces. But yeah, you can use things like a 3-day rule. You can use retakes of key technical levels. You can use retakes of key moving averages. You can use trend reversals. So if a stock is in a downtrend and you're just most people typically see those on Twitter at least as just a line on a trend, and the stock breaks out of that trend convincingly and begins an uptrend in a separate channel, that's a form of a reversal. So there's no single definition for it. I think in a market like this where a lot of people are trying to call bottoms. I think my favorite example of it is probably Upstart because it was such a popular stock last year. It ran to, what did it run to at the peak? Like $400, trading around 100 now. But, I've had friends that own this stock. And I saw people on Twitter trading this stock, and a lot of people on the way down were trying to call bottoms. That they felt like were technically reinforced, but sentiment just continued to drive this down, along with a number of other growth and tech names that are down, 60 to 80% or even more from their highs. It's really a sentiment-driven game. Even the best technical analysts, I think, in the market, or even the best technical analysts that I know, couldn't have charted the course for the major indexes over the course of the last 2 weeks. They certainly couldn't have called bottoms on individual equities. So I think looking for some sign of a trend reversal, as you're saying, is critical in a market like this because, just guessing bottoms based on price history or key price levels or what you view as a stock that's basing isn't really enough in a sentiment-driven market where either economic data that comes out can cause flushes, or as we've seen over the course of the last few weeks, we've seen intraday flushes in reaction to geopolitical tensions. So there's so many catalyst events in a market like this that I think that really the consistent thing to do is to trade news and catalysts or to trade sympathy trades. And that's the two things that I've been really leaning on as my bread and butter for the last few months. Trading stocks with an obvious and apparent catalyst that actually adds value to the company and will recruit, actual equity buyers, and you won't just see a move like we were talking about before that's spurred by, options flow or, what I call lightweight sentiment. When you're looking for those kind of moves, the convincing and consistent moves in a market like this are either news or ER beats, right? That's what we've seen the course of the last few weeks, especially with these massive ER beats that are either, the Amazon beat for all intents and purposes, at least for the next session, held up the market. We saw the Google beat too that shifted sentiment on a dime. Seeing these kind of dumps and rallies from ERs and then seeing, all of the intraday leaders in price action. Like I'm pre-market. I do a lot of pre-market scalping. It's not like the only thing I do, but I generally am up at 3 or 4 a.m. Central and viewing the first slivers of volume come into stocks. The pre-market leaders for the last several weeks have all been catalyst driven. They've all been news or ER driven. And the beauty of it is I always say in a market like this where there's so much chop, it's better to be reactive than predictive. Employing strategies like sympathy trading allows you to do that effectively in a market like this because If a stock is running or is exploding on news that you didn't catch, if you didn't already have a position in that stock, now by very virtue of trading it, at least if you're doing it intraday or even if you're swing trading it, you're momentum trading at that point. And finding appropriate entries in momentum trading is one of the most difficult things to do in trading. If you're scalping for a few percent at a time, you can do it effectively, but most people don't have the discipline for that. What sympathy trading allows you to do is it allows you to identify a primary runner and then find related stocks that are very likely to run in sympathy. And in most cases, as long as they're not brand new equities that just IPO'd, you can look at the price history, compare them to sector peers, compare them to business partners, compare them to companies that have an intimate product service relationship. There's a number of ways to tie a sympathy between two stocks, but identifying primary runners, deciding not to participate in the trade of the primary runner, and then deferring to trade a stock that should run in sympathy, that's worked very effectively for me over the last several weeks. And I think, those kind of strategies prevent you from really having to guess bottoms or call bottoms in a market like this, which is hard to do.
I agree. I would also add in that, we don't necessarily have to just look at the U.S. market. There are some other markets that are much more constructive in 2022. In fact, the U.S. is one of the bottom global performers. And if you look around, say, in Latin America, Brazil's up 18% in a month. Chile is up 9.6%. South Africa's up 9%. Peru's up 7%. Singapore is up 6%. So there are other opportunities globally to distribute into, and that's one of the strategies that I've been putting on because these are markets that have been kind of chronic underperformers and have some attractive valuations, and B, they're kind of further along in their tightening cycles, a lot of these, so I'm not as worried about the kind of risk that we have here with a frothy market and an environment of increasing cost of capital and a potential slowing economy and maybe some persistent inflation. And the other thing that I've been really looking at that's been a good trade really since summer, but also just the start of this year, it's been an outperformer versus the S&P, is agriculture. Soy, corn, wheat, oats, or you can just look at an ETF like DBA, which is up, I think, 50% since the summer. There's some opportunities in unconventional areas that I think it's important to, especially if you're systematic or a trend follower, the more asset classes that we're looking for these opportunities in, the better that we can have performance. But also there's just smoother uptrends with less volatility that to me is a little bit more attractive as well.
Well said.
A lot of great points there. In terms of just like some of these different groups, like I'm looking at the same thing. I am seeing that international markets are actually performing pretty well. But even when I look at the US market, I know we're talking about like how do you know when something is bottomed? But I'm pretty much looking at all of these indices and I'm like, what hasn't bottomed yet? Like to me, it looks like everything is bottomed. Like I'm looking at the S&P 500, for instance, the SPY. And peak to trough, we were down about 10% from the highs for the correction. And now we've already reclaimed 61.8% of the drop. So I think with a lot of traders and investors, what I'm seeing, like I see this landscape ahead of like, okay, the Fed is tightening, the liquidity backdrop is going to get worse. For everyone that's experienced in the markets, we all know how important that is. A couple of weeks ago, we just got to a level where the market just had a huge correction and everyone was bearish. Everyone was hedged. No one was positioned. Everyone had sold everything they owned. And the VIX was so high that it was just really tough to get any meaningful progress lower. Now, as I look at this, to me, it seems like, we've had a huge bounce. And if you've been able to capitalize on some of this move higher in the indices, now I'm almost looking at it, I'm like, the risk reward doesn't really look great. But I'm seeing a lot of traders and investors that were super skeptical a couple of weeks ago that now after this, 6-7% move back up, now they're like, oh, okay, I think I'm starting to get my confidence back. And I think later in the year, that's where people can run into issues. Like if this bounce just sucks everyone right back in, and then later in the year, the liquidity backdrop gets a little bit worse, and then, we just roll right back over.
Yeah, I think that's a really good point. I'd like to add into to what Andrew's saying too, because I think the other thing that we saw, really in late January was this sort of washout across multiple metrics. Like if you look at the National Association of Active Investment Managers, they were at some of the lowest readings that we had seen since early December, which was another kind of washout low sentiment positioning. Some of them were getting more net short. We also saw, retail bearishness, which isn't the best survey, but AAII was getting to extremes we hadn't seen since 2020. We saw the New York McClellan oscillator and the NASDAQ McClellan oscillator reaching lows that we hadn't seen since early December, and before that, July, and they're noteworthy when they get below negative 80. And so there's just a lot of different metrics. Put call ratios were getting pretty skewed at the index level and the equity level, just suggesting there were some, sentiment extremes. And like Andrew said, a lot of hedging and people taking off positions, even putting on directional bets. So it got blown out one way, and we've seen that wash out. Sentiment is certainly not at a greedy extreme or anything resembling that. But what concerns me about what we saw today in options is we're starting to see that come back in. And it's kind of like Andrew said, we're starting to see people kind of get comfortable coming back in, at least doing these punts. And that's kind of how it starts. So I do think it's important to be careful about managing risk. Like I'm still of the mindset of taking positions that are of smaller size and for shorter time frames, and managing those, with two-legged cancel on open orders, trailing stop, and a price target that's set on a key level. And I manage those trades, but I do think that we're not necessarily out of the woods yet. And one area that I don't see anything resembling a real bottom in right now is the Russell 2000. And it concerns me because it had this really big fake breakout in November. And ever since then, it's just been, kind of lower highs and lower lows. And I just have a bad feeling about the lack of participation from these small caps in this market, that it's a sign of ill health overall in terms of breadth and in terms of risk appetite.
Yeah, markets for mayhem. I do want to tag onto that. I was watching small caps very, very closely. I'm a big index guy. And I felt that if small caps broke out, which they looked like they were going to back in November, then that'd be a major catalyst for the entire market to lead. But yeah, that fake breakout back in November and just lower since then is not a sign of a healthy market. So you gotta keep that in the back of your head. We are seeing these stocks bottom. We are seeing these indexes, reverse. We're still below the 50-day moving average on both the S&P and the NASDAQ. So until we get above those levels, I'm cautiously optimistic.
Yeah, I just want to add on. I think those are great points that you're making. I think the biggest question right now is: are we going to see another V bottom, and have we bottomed, or is this to the point of we reached, a lot of sentiment extremes? Is this just a snapback rally, and then we'll form a W bottom? And obviously, nobody knows the answer, but I think the way to resolve that when you have mixed signals or mixed picture is to just trade a little bit lighter. That way, if things do go higher, you still make some money. But, the primary job, I think, for everybody should be to manage risk. And that's when you study the greatest traders in the world from all the market wizards books and all that. What do they preach? Defense, defense, defense. So I would rather, be a little bit smaller position, because you just don't know if we're going to rally into that 50-day on the NASDAQ and S&P, get everyone all invested again, active managers, like you said, signs of call buying coming back in, and then we just have another flush ahead of the Fed meeting. You don't know that, so I think it's just still, I like the cautiously optimistic, but I think you still have to let the market prove itself a little bit before getting too aggressive at this point.
Yeah, I definitely agree. The sentiment, even now it's still pretty bad. Like, people saying like, have we bottomed yet? And like, this is why I like having rules around my trading process, where like, if it were up to me, like I would still be in 100% cash, and I would be like, in like a bunker right now with like a bunch of gold bars. But I'm just following my process, and my process is telling me to, remain long for now. And I'm always open to being wrong. If it ends up being wrong, that's perfectly fine. I'll stop out and, go along my merry way. But it's kind of funny because I remember like in 2018, everyone got super scared. We had that 20% correction. Granted, it's not the same scenario, but it was really funny because it was like, there's no way the market can go back to the highs. We're 20% off. And a lot of times people only realize it like once you're back at the highs. Like same thing with the COVID crash. it was like this disbelief on the way up, like there's no way this is happening. And before we knew it, we were at the highs. It's kind of interesting. Like the S&P 500, it's only 3.2% off the highs now. So like all it's going to take really, all it would take is like a couple of good days. And I think there would be a lot of people scratching their heads going, have we bottomed yet? And we're literally trading at all-time highs.
Yeah, I mean it's a fair point. I think what created two V bottoms that are in recent history was Fed intervention, which is what helped. I'm not going to blame the Fed. I'm not one of these like psychos about the Fed, but I just think that in 2018, keep in mind the Fed was raising rates. They were raising rates throughout the year, and then Powell came out and said at the end of September of 18, he said, "Look, we're going to raise 3 or 4 more times." The market clearly couldn't handle that. We dropped 10%. He raised again in December of 18 and said we're probably going to reduce our balance sheet. Sound familiar? The market dropped another 10%, 20 total, and then that Powell pivot came, which created sort of that V bottom in January of 19. The other time in recent memory was during the pandemic, which you can't blame the Fed, a once in a century pandemic. They didn't just throw a bazooka, they threw everything at the market. So my point is the difference between those two V bottoms and now is I can't see the Fed coming to the market's rescue because they're in a tightening cycle and they haven't even started to raise rates. So that's a huge variable versus some of the V bottoms we've seen in the past.
Yeah, I absolutely agree. I also think that what we really saw, in addition to the rate hikes by the Fed in really starting in like 2017 to 2018, really spooking the market, but also quantitative tightening was a big problem. Just the idea of running off the balance sheet is a really big concern when, like we're talking about, when you're adding liquidity into the market, it's like you've got a bunch of beach balls and there's these different asset classes. They're all in an empty pool. You open up that spigot and everything rises with the level of liquidity in markets. And once you start draining out that liquidity, the opposite happens. And there's also not just the aggregate size of liquidity to consider, but the velocity of that liquidity to consider. And it's kind of interesting that when you go back on those charts and you look at year over year velocity, you saw that when that velocity started to go negative, as QT had happened back in 2018, that was around the same time the market started to have a pretty serious pull downward because you're basically doing QE in reverse. You're sucking liquidity out of the market, and that's not necessarily going to be good for risk assets. And we saw this time around that, like you said, when this crisis happened, this was not a gradual easing process that we usually see with like one rate cut, another rate cut. Maybe we'll do some QE like we did after the great financial crisis. It was cut to zero, flood the market with over $10 trillion of Fed balance sheet liquidity, and then keep the spigot running with monthly 120 billion QE and 80 billion of treasuries and 40 billion in mortgage-backed securities. But that initial wall of liquidity from global central banks created this inordinate velocity that just put a bid under everything in April of 2020 on to like the first half of February of 2021. And that was when that velocity of liquidity started to gradually erode from February to May, when things started to get choppy. And we also started to see interest rates come up, not only on a nominal level, but a real level, which has a big impact on all these long duration risk assets, because really that's what growth stocks are, right? They're not producing money in the here and now. There's an idea that hopefully maybe in the future they're going to produce money, and they become a long duration risk asset. So when you see real rates start to creep higher and treasuries are no longer return-free risk, and there's other opportunities in fixed income, which, by the way, most of the money in this country is held by people that are near or at retirement age, and they're probably looking to de-risk a little bit. So those opportunities come up, and people want to be a little bit less involved with risk. So you can kind of see that happening now, where you have velocity continuing to come down. And now the Fed is also talking about doing QT again. And I think, whatever we might think of central banks, ultimately at the end of the day, this has been a liquidity-driven bull market. And in many ways, that's been a driver of upward price revisions. There's a pretty strong correlation with the size of the central bank's balance sheets and the performance of the S&P 500 and the Wilshire 5000. And so if we see liquidity really running off, and I don't mean just passive runoff, letting maturities, run off the balance sheet, I think that would be digested well. But if we're talking about an active runoff of over $1 trillion a year, I think that's going to be a hard pill to swallow for a market that's really been bid up by a lot of that liquidity to begin with.
Yeah, those are all great points. The big question is I don't know if it's, some people are saying it's priced in already, and my gut feeling is I don't know if the market's taking this seriously or not.
Yeah.
Because I feel like, when we get through earnings season, I call the third month of the quarter no man's land, when most of the earnings season is done and all the news shifts to basically bullshit, which is like geopolitical concerns, interest rates. Because right now we're talking about Apple's earnings and Amazon's earnings and Chipotle's earnings. But once you get through the next couple of weeks and you get into that Fed meeting, guess what is going to be driving the news? It's going to be all geopolitical and interest rate stuff, mostly Fed stuff. And I don't know if the market's really priced in, because they haven't even, someone's like, oh, the market's priced in 4 hikes already. I don't know if it really has, because they haven't even done anything. And to your point, if the balance sheet becomes a factor, the velocity of that, you still have to wait and see. And from my 2 cents, I talk to a lot of traders. I feel there's more people with fear of missing out the upside, FOMO of the upside, than protecting capital on the downside.
Yep.
And I just think that's, I understand that mentality, because the last 2 years has been an X equals Y straight up, buy the dip, shut up, buy the dip. I get that, but there's a reason Marty Zweig's had one of the greatest quotes: "Don't fight the Fed and don't fight the tape." And especially don't fight the Fed. You don't want to fight the Fed when they're providing all that liquidity on the upside, and it is a liquidity-driven bull market, globally coordinated by all the central banks. And, like they say, don't fight the Fed. Good luck fighting 30 central banks on the way up. Now they're all starting to tighten, so you don't want to fight them on the way down. So it's still worth, in my view, being defensive until we get a clearer picture.
Yeah, I 100% agree.
I
100% agree.
I'm going to come in here. I'm going to just a couple of DMs. So I do want to bring it to a couple people, because some people on this panel do have commitments at 8, and I want to get them involved. And then I also want to center this a little bit more on the trending stocks and just make sure everyone has a chance to get involved. So we're going to probably move back at this point to just moving off of moderation, but did definitely enjoy the open conversation as well. So stock market news, I know you have some stuff, and then Luke, you do too. So stock market news, want to go to you real quick for a minute or two if you want to pipe in, and then we'll throw it to Luke.
Yeah, I'll keep my part pretty brief. Definitely a great spaces. Love listening in on this so far. For me, when I look at the title, the first stock that comes to mind today has to be Disney with their earnings. So maybe get some thoughts around that. Obviously, the stock is up around 7%, so someone thought some good stuff happened. The numbers were pretty solid across a bunch of different platforms, beating expectations. I can go specifically into some of the numbers. Some of them were top line headline numbers when you look at subscribers, and subscriber growth came in at about 11.1 million. I believe expectations were somewhere between like 5 to 7 million. They beat on EPS, beat on revenue, beat on parks expectations. A lot of really good stuff on this Disney quarter. I know the stock is up about 7% right now in after hours. So maybe dig a little bit more into that if we want to. After we kind of go through these things, I do just in general want to say, if you enjoy the space, if you enjoy anything anyone specific had to say, go in and check out their profiles and give everyone a follow. These speakers come in here for free and share immense amounts of value, and the least that we can ask you to do is check out their profiles, check out what they're doing, and give them a follow. It's really simple, it's easy, it's free, and I've been saying this a bunch. The truth of it is you can hit that unfollow button really, really easily, and it won't let us know or anything like that. You're not going to want to, but the option is always there. So I'll keep it briefly out there. My stock pick that I would say, probably got the most views across most platforms today is going to be Disney. Hard beat of Tesla, which is probably up there every single day. But yeah, back to you, Gav.
Good stuff, man. Appreciate it. Thank you for tuning in as always. And I know that you have some stuff that you've got to do. But yeah, he's definitely right. Everybody up here is fantastic to be following, especially if you're interested in all types of investing. Really diverse panel. A lot of technical people up here, but definitely a lot of fundamental people as well. People that are macro and micro, a little bit of all different angles, and people who are just awesome to listen to on spaces with, a wealth of knowledge. So I'm grateful to be able to learn from them too. Okay, Luke, we kind of did an hour here. We didn't go too far. I guess we did some of the large caps that you talked about, but maybe we'll have to run this back, diving into more of the trending stocks, but still love the conversation. I would love to throw the next few minutes just over to you if there's anything else that you want to add or talk about stuff that you're doing.
Yeah, trending stocks. Couple thoughts here, and keep in mind one thing that I have the advantage of looking at when we're looking at trending stocks is all the readership on Benzinga.com. We get, let's call it 20 million people a month or so that are visiting Benzinga.com, reading news, looking at stock profile pages, searching things, etc. And there are two things that jump out. Of course, there's always going to be the Disneys when we have a day like this. Tesla's up there every day, like was just mentioned. But there have been two topics that died, incredibly popular, died, and all of a sudden, let's call it the past week or so, the past several days, have been popping up on our radar is really, really hot for readers. That the one is Dogecoin. We saw the crazy Dogeness this summer. It persisted for a while. It died. The world went back to stocks. I was happy when the world went back to stocks. All of a sudden, Dogecoin is back on top readership lists. I don't follow the altcoins very closely, so I don't know what it is. If there's something that's triggering that, if there's some sort of news catalyst, but I'm just putting the information out there that the readership and the interest that we've seen in Doge is not nearly what it was in the past, but it's climbed up back into that leaderboard. Second topic of major interest, super hot this past summer, died, got no love. All the Cathie Wood stuff. When she's buying stocks, she's selling stocks. We're covering those on Benzinga.com. This ever since we got this market choppiness, all of the Cathie Wood names, articles, etc., stocks she likes, came back into play. I'm not necessarily endorsing any of those stocks or saying that they've followed that readership pattern. But again, I think it's worthwhile for everybody out there who's listening to be able to have that insight to say, like, hey, retail crowd. I mean, that's the crowd we're going after. We're here for retail investors. That's who we write for. That's who reads Benzinga. Cathie Wood has been hot again.
Really, really good stuff. And then I know, I don't know if the person who's on the Benzinga account, if you wanted to chime in with anything. No worries. If not, we're definitely grateful to have you up here.
I'll chime in for them. And what I'll say is this: anybody out there, if you care about news at all, and like what's coming out, what's breaking, what some of these catalysts are, you want to get the earnings in real time, deals, whatever it is, go check out Benzinga Pro. It's just benzingapro.com. Basically what we're trying to do is we're trying to take what exists in the Bloomberg terminal, right? Like the $26,000 a year thing that exists for institutions and bring it for the individual. It's totally free for 2 weeks. There's no credit card for a trial. There's nothing along those lines. It's literally all you have to do is type in your email address, check it out. I'm biased because I've been working on Benzinga Pro for many, many years now. But for me as somebody who's swing trading and doing stock picking, without having those narratives that are surrounding the stocks and what's going on, seeing all the insider transactions, the institutions, etc., I couldn't live without it. And again, it's totally free, so worth at least kicking the tires. And if you need help navigating it, just shoot me a DM, and I'd be happy to walk you through. That's my last bit.
Appreciate you being on here, Luke.
Absolutely, man. Thank you for inviting me.
Awesome.
Happy trading, everyone.
Yeah, looking forward to connecting more on that conference as well.
Yeah, exactly. Everybody's listening. We're hosting a cannabis investment conference, April 20th. Again, shoot me a message. I'll hook it up. But basically, we're going to have all the public company cannabis CEOs presenting over 2 days. You can talk to them, ask them questions, understand their businesses. It's definitely a space that's been beaten down, but there's a lot of really interesting things happening in the cannabis space. And it's rare that people like you and I can have access to all these public company executives. So April 20th, Miami, interests you at all, shoot me a message and I will get it hooked up.
Perfect. Thank you. Loving it, Luke. All right. And I think I'll be back on the Benzinga show actually next week. I've been chatting with Bri, so looking forward to that.
There we go. Peace, man.
Okay. So let's bring it in to a little bit more of the stock talk maybe for the next 30-ish minutes. And just go over some of these trending stocks and just, see what we're liking and not. If anyone tuned in last night, we had a bunch of picks that did great today. So would love to kind of follow up on that. Joe,